Zeroing in now on the banks in particular, my next guest says even with one more rate hike, bank balance sheets are adjusting, and the regionals are so beaten down that they're a buy here, especially if you play it through the KRE Regional Bank ETF. Joining me now is Mark Avallone, president of Potomac Wealth Advisors. Mark, it's good to see you. Welcome.
Good to be here.
You know, maybe that should feel like a safe call, but it still feels like going out on a limb a little bit because the banks, the banking system can just be its own animal. And what gives you the confidence to say, especially buying, an ETF with exposure, that, this is safe treading here?
Well, it's not an easy trade, and it's not today run out and buy this. It's the reality that it's down significantly off its peak, and it was largely because of an asset liability mismanagement and pricing of bonds on SVB's bank balance sheet. Every day that goes forward where rates have stabilized and they're even a little lower off their highs, every day bonds in a bank portfolio mature closer to par. So the thought that there's continued deterioration if we have stable rates is unfounded. And if rates start to drip down a little, and we think the Fed is at or around the last of its rate hikes, we think the balance sheet of banks in the financial system is going to improve. And investors have overreacted. It's understandable. But you want to go where the value is. And I would rather be in a beaten down sector that was sold off on emotion than one that's being bid up on a lot of hype and promise and is overvalued by historical standards.
Meaning defense, aerospace, industrials, areas we've talked to you about before that you like. So what do you think is going on with tech stocks or NVIDIA or the AI boom? However you want to describe it.
Well, I've always said we never abandoned the tech trade, and I'm glad we didn't. But that was mostly because we thought in a slowing growth environment, investors would want tech. Frankly, I little underestimated the impact of this AI frenzy, as did a lot of people. So at this point, we're not getting out of tech, even though we feel it's fully run up and is vulnerable, but we're not allocating new money. I think it's a long-term investment to be in these big mega cap names. If you try to time them too much, look, you could have missed a great move from NVIDIA if you had gotten out when it was near $100 a share just a few months ago. So they moved too far, too fast, but I wouldn't back up the truck and build a balanced portfolio around an area just because it's the hottest sector.
And why, just kind of going back to circle in on your point about the regional banks, why not, pick name by name, maybe a name that has been a strong performer, you have, some personal knowledge of, as opposed to the ETF where, there's a lot in there for better or for worse?
I thought you were going to ask that, and I came up with the answer that unless I'm reading the bank's reports they're filing with the Fed, and I'm combing through every annual report and doing the asset liability analysis myself, and I know about the commercial loan portfolio and what's under the hood, I am going to diversify that single bank risk away. One other thing I didn't mention on a positive on regional banks is they do not own a significant amount on a relative basis of commercial real estate. So I don't think their loan books are perilous relative to some other banks, more concerned about some smaller banks with higher percentage of real estate, commercial loans. So I think in general, the balance sheets of these banks are strong. They're going to improve. And I would rather have a diversified basket of them as opposed to one bank that might give me an unpleasant surprise.
He had the answer ready to go. It makes a lot of sense from that point of view. Mark, thanks for your time today. It's good to see you. Wait, by the way, before I let you go, just a parting comment. 4,200 on the S&P. We've cleared the debt ceiling and all the rest of it. What do you tell people about simply the next move for the equity market? And is it a move that is fundamentally justified to you or just a momentum kind of play?
I think if we're talking in early next year, people will be glad they stayed in the market. But if they think it's going to be without a bumpy ride, whether it's getting this trade deal, this debt deal approved, if it's an earnings disappointment, remember this market multiple is inflated, and it's inflated because it's expecting earnings to deliver. So I think if we work through a few quarters of that, I think investors, if they sit tight till next year, are going to be pleased they did and should consider expanding exposure to stocks on any pullback or weakness.
All right, Mark Avallone, a pleasure. Thanks for your time.